So hello everybody. I just wanted to give you a quick brief discussion with regards to Chapter 11 and cash flows. This slide I'm looking at here, which is slide 6, is a pretty important slide. It sets up the work that you'll be doing for the rest of this chapter. You'll be computing the initial investment for a project, that the money is going to come out of your pocket to start the project. Number 2 is the operating cash inflows, the money that result from the implementation of a project. And I mean, of course, everyone hopes that's positive and cash comes in. And then, of course, the terminal cash flow in the final year of the project. And it comes down to, are you going to liquidate it or scrap it or just, salvage it? So, so these three components you'll be going through mathematically. So as I go through this, here's a figure 11.1 on slide 7, just as an example. Here's the initial investment of $50,000. Here's your operating cash flows for each year, all positive. And then, of course, you have a terminal cash flow where you probably either sell off the hardware or the project itself, and you collect an additional $25,000. So I'm going to jump ahead. These two terms are pretty important before I jump ahead. Know what sunk costs and opportunity costs are, okay? Because these work well for a multiple choice or a question where I can trick you into something, or a true and false or something like that. All right, so I'm going to jump ahead a little bit here, and so slide 15 is the basic format for determining an initial investment. And you'll notice here how much it's going to cost to buy the new asset. And you'll notice the installed cost of the new asset includes the cost of the asset itself and the installation costs. And, a simple example of that would be if you had a new air conditioner put in your house, you would basically pay for the air conditioner, and then the plumber or the electrician would come over and say, well, the labor to install it's going to be, an extra $500. Okay, so here's the after-tax proceeds from selling the old asset. Maybe you have an old air conditioner and you wanted to sell it to somebody because it still worked. Somebody would be willing to buy it off you. And over here is if you're going to pay tax on the sale. Most people don't, of course, right? Everyone tries to avoid taxes in the real world. And then, of course, you have the change in net working capital. Change in net working capital is a little confusing at times, but basically what it says to you is let's assume you're putting in a new piece of equipment, and it's so complex you have to hire a computer programmer to take care of it because it has a computer program. Well, you'd have to pay in number 3 for this computer programmer. So you'll notice over here the plus or minus 3. It would be, in this case, your initial investment would have a plus 3 here because now you'd have to pay for this computer programmer. On the other hand, if the new machine was completely automated and you could lay somebody off because you didn't have to take care of that machine anymore, this would be a minus 3, right? Because now you're eliminating a salary. So change in net working capital will either add to your initial investment or subtract, depending on your investment in this initial project. Okay, so I'm going to jump a little bit ahead. If you have any questions at any time, of course, you can email me. So here's an example of an actual worked out example of the initial investment, and they show you how to do this here, including taxes. Taxes are important. And this is an very important slide. Slide 20, they basically tell you if, how much taxes you have to pay on the old asset. If you have recaptured depreciation, you should look up these words, recaptured depreciation and capital gains. They're very important to know. Recaptured depreciation simply refers to the fact that you've been depreciating something over the years, and now it winds up that you sell it at a higher value. Okay, you're not allowed to write off something and then not pay taxes on it. So it's called, taxes on recapture depreciation. In other words, you can't have your cake and eat it too, so to speak. All right, so we go through all these examples, and I hope you have, you find it easy. And again, you can just email me. And here's a good slide. Slide 23 is excellent. They show you if you make an initial purchase here of $100,000 and you sell something for $110,000 here, you're going to have a capital gain, of course, of that difference of $10,000. And obviously, if the initial purchase price was $100,000 and you basically sold it for $110,000, as I said, you have $10,000 in capital gains, and then you're going to basically have you'll have some recaptured depreciation here of if the book value was only $48,000 because you've been depreciating it. So now you basically have to pay taxes on this $48,000. Once again, you can't have you can't have your cake and eat it too. So that $52,000 gain, okay, because it's only worth $48,000 and you sold it for $110,000, kind of means that you've got to pay taxes on that $52,000 difference between this and this, plus the $10,000 capital gain tax. So I would go through this slide carefully. All right, and as I mentioned already with net working capital, this slide tells you about changes in net working capital, whether or not it's a positive or a loss. And here's how you here's an example slide, table 11.3 of net working capital. And here's the final initial investment calculation for you to go through on slide 27. And they go through the whole thing on slide 28 again. And then we move on to the operating cash inflows. And you'll notice here, here's the proposed machine, and here's the present machine you have. So this is the new machine you're thinking about buying, and here's the revenue you can generate, and here's the expenses associated with it, as opposed to the revenue and expenses of the old machine. And here they give you basically the cost of the proposed machine here that you're going to buy, the new machine, and how you'll be able to depreciate that. Go back in the early chapters to look over depreciation. You should have had that in other classes. And here you are, how much you're going to depreciate it every year. All right, so here's the present machine, and you're in your last 3 years of depreciation here. Again, so here's how one calculates the income statement cash inflows. Here's your expenses, and here's your revenue minus your expenses. Give you your earnings before depreciation, interest and taxes. And here's your depreciation, which leaves you with EBIT, earnings before interest and taxes. And when you subtract off the taxes, you have your net operating profit after taxes. And they show you a simple equation for that here, which you shouldn't forget. And then you add notice you add the depreciation back on. The depreciation helps you save taxes, but it's a non-cash charge. Okay, and that gives you your true operating cash inflows. And here's that. Here it is broken down year by year. You should be able to go over it little by little. And here is the present machine. That previous slide was the proposed machine, as you can see. And here is the present machine over here. So you've got the cash flows associated with both. And you can see they list the new machine cash flows and the present machine cash flows. And the difference kind of makes you question whether or not you want to do it. And obviously, you got a positive cash flow between the new machine and the old machine. So I would simply say it was a positive thing to put that new machine in. Okay? All right, so I'm going to stop here for now. And you could go over the slides from 38 to 54 to calculate the terminal cash flow. And if you have any questions on that, please don't hesitate to email me. All right, talk to you later.